All right, we're back with another Q&A session. And the question is, what are the eligibility requirements for getting an SBA loan to open a franchise? It's going to vary bank to bank, lender to lender, because not all banks, it could be credit unions, it could be non-bank SBA lenders. But here are the generals. If it is a loan amount of $150,000 or less, we can go up to a 90% of total project costs if it's an approved franchise. Generally, larger loans are going to be 80% of total project costs. And let's talk about the larger loans that are going to be over $150,000. Generally, you need to put down, obviously, your equity injection would be 20% of the total cost. They also want to see 10% post-close liquidity. Now, each bank, although they underwrite and use the SBA SOP as their kind of, underwriting guidelines, they all have different ways of interpreting the SOP. So, and some are more conservative than others as far as lenders. So generally, the larger banks that are in the franchise startup space, they'll do 80% of total project costs. Now, when the loan amount's under $500,000, they're going to run you through a scoring system called SPSS, which was designed by FICO for SBA loans. And it's going to automatically score you between 0 to 300. Each bank has a little bit scoring caveat, but let's just say Bank 1 says you need to have a 165 or better score on this SPSS. If you go past, they enabled the SPSS credit scoring system to kind of streamline small SBA loans in a more efficient way. So you have to score with these loans that are under 500K. So generally, they look on a franchise startup, they look at total project cost. So let's just say it's $200,000. Well, you're going to have to come in with a 20% down payment or equity injection, right? So that's $40,000. Now, the total project cost is $200,000. They need 10% post-close liquidity. So they're going to look at that 200 grand and they're going to say, okay, we need 10% of that after you put your down payment down. Essentially, right? That's another 20 grand. So to close on this deal, you'd need about 60,000 liquid. Now that down payment could come from an investor partner or it could be a gift, but general rule of thumb is 20% of total cost coming in from you, and you have to have 10% post-close liquidity. You have to score via the SPSS credit scoring system. Franchise should be within a 2.5 hour radius. Most banks like that, not all banks. I'm just speaking in generals right now because we can figure ways to get things done, but just high level. Generally, they like to see outside income that supports outside debts. So we don't look at DTI as much, but we call it global cash flow. So that's really the meat and potato of franchise startup financing. I hope that helps. Go to bookwithbeau.com if you have any additional questions. Look forward to working with you in the future.
If you're looking to acquire a business, stop scrolling on Biz Buy Sell and visit franchiseresellelistings.com. We'll do a customized search. You can get on our weekly distribution where we're sending new inventory weekly to your inbox. So visit franchiseresellelistings.com and opt in today. See you there.
Hey guys, Beau Eckstein here. If you enjoyed what you saw, please subscribe to this channel. We talk all things financing. I've been in the lending industry for over 20 years, and I'm happy to answer your questions and provide great content.